$1,600. That's how much Trump's brilliant idea to start a trade war against Canada and Mexico is going to cost every American family. And guess what? The OECD has just confirmed that the United States is about to shoot itself in the foot like a perfect amateur. I'm Antonio Fantigrossi, and today I'm going to show you how a superpower can self destruct with the same intelligence as someone trying to put out a fire with gasoline. We'll examine the shocking OECD data, why this situation is a déjà vu of the Great Depression, and, most importantly, where the smart money is going as the American economy begins its slow suicide. Let's start with the cold hard facts. The OECD has just published its economic outlook, and the news is disastrous for anyone living north of the Rio Grande. The United States will see growth slow to 2.2% this year, and then fall to 1.6% in 2026. Mexico, even worse. It will enter a full recession of negative 1.3% in 2025 and negative 0.6% the following year. A festival of joy indeed. And Canada? Growth halved to 0.7%. Essentially, an economy moving at the speed of an arthritic sloth. But why are these tariffs terrifying economists around the world? Easy. Do you remember the Smoot-Hawley Tariff Act of 1930? You don't? Well, apparently neither does Trump. This stroke of genius triggered a global trade war that turned a recession into the Great Depression. Almost a century later, here we are again with the same script. It is like watching a remake of a film that was terrible the first time. But there's a fundamental difference. In 1930, we didn't have such interconnected global supply chains. Today, the United States depends on its neighbors for hundreds of thousands of essential components. It's like picking a fight with your baker, butcher, and greengrocer, and then being surprised when you have nothing to eat. Let's take a look at what all this means for investors. First, will tariffs really make America great again? The OECD estimates that the direct cost to US families will be $1,600 a year. And the economic slowdown will cost the US more than the tariffs will generate in additional revenue. In essence, Trump is taxing Americans to protect Americans, a masterpiece of circular logic that even Escher couldn't have designed better. Second, with inflation expected to rise plus 0.4% globally, central banks may keep rates higher for longer. Say goodbye to those hoped for rate cuts. The stock market is already shivering like a chihuahua at the North Pole. Third, increased volatility. Trade wars are like real wars. Once they start, it's hard to predict where they'll end. Remember the sanctions against Russia? The narrative was, we're going to hit Putin, but they devastated European companies. You didn't need a Nobel Prize to figure that out. Well, they gave Obama one for peace. So maybe you did. Now Trump is targeting Canada and Mexico. But the boomerang could hit the US economy. If other countries retaliate, and China is already doing so, we could see a spiral of retaliation, putting additional pressure on markets. The VIX could return to pandemic levels where we hoarded pasta as if it would disappear tomorrow. So where is the smart money going in the coming months? Europe, less exposed to the trade war, will see growth of 1.0% in 2025 and 1.2% in 2026. Not exactly a post-war boom, but better than going into recession. Despite the tensions, China is forecast to grow by 4.8% in 2025. The dragon seems unstoppable even with tariffs, like a high-speed train on golden rails. Then there are the defensive sectors. Utilities and consumer staples could come back into favor in a context of uncertainty and inflation. After all, in times of crisis, People can go without the new iPhone, but hardly without food or electricity. What does the future hold? We have three possible scenarios. Optimistic scenario: Trump uses tariffs only as a bargaining chip and quickly reaches new agreements. Basically, the bedtime story that Wall Street tells itself before bed. Realistic scenario: Tariffs remain in place for at least a year, causing trade to contract and inflation to rise. The Fed delays rate cuts, the stock market corrects by 10 to 15%. Not the end of the world, but not a walk in the park. Pessimistic scenario: Global escalation of the trade war, with Europe and others joining the retaliation. Recession in the US by the end of 2025. Debt crisis in Mexico. Market crash of more than 20%. In short, a financial apocalypse with the four horsemen riding on the bearish bull. Tariffs are like medieval walls. Outsiders pay the toll, but insiders pay to build and maintain them. But what does all this mean for our portfolios? In US equities, look at sectors exposed to Canada and Mexico: automobiles, technology, energy. Their supply chains are as intertwined as a plate of spaghetti. Treasuries may benefit from the flight to quality in the short term, but inflation will punish them in the long term. It's essentially a short cover. The Mexican peso and the Canadian dollar are already under pressure and could fall further. Any lower, and they'd only appreciate if they found oil in their backyard. History teaches us that trade wars have no winners, only losers. It's like a game of Risk, where everyone loses territory. But will this time be different? Will Trump succeed where Hoover failed miserably? Or will we discover once again that economic isolationism is the shortest path to decline? What do you think? Will tariffs really protect the American economy or sink it? Write in the comments. I want to know if you're on team protective protectionism or team economic own goal. If you like this video, leave a like, subscribe to the channel and hit the notification bell so you don't miss future updates. Because finance may be complicated, but understanding it doesn't have to be. I'm Antonio Fantigrossi. See you in the next video.